They're going to be in trouble, and either they have to deal with the political reality of having to cut government spending dramatically, or they've got to pull out of the Eurozone entirely and go back to their own currencies, which will be an even bigger disaster. It would involve too much political pain, economic pain, bankruptcies, foreclosures. Investors would lose a lot of money. A lot of people would lose their jobs. All this is necessary. This is all part of creative destruction. It's all what the free market needs to do to purge the economy of all the mistakes that were made.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
You know, if you recall, when Mario Draghi was at the head of the ECB, his main concern was that there wasn't enough inflation in Europe. Yep. And he constantly said, we're below 2% and we need to get close to, but not 2%. He always said, look, we don't want 2%. We want to get 1.999. You know, he said, we can't touch 2%, but we got to get really, really close to 2%. And apparently for years, Europe wasn't close enough. If it was 1.5% or whatever it was, this was this major problem that the ECB was determined to solve. And at the time, I was pointing out how ridiculous this was. And I had wished one of the reporters would have asked Mario Draghi, why? Why is it so important that the cost of living go up by 1.99%? Why can't it go up by 1.5% or 1%? Or why can't it go down? What would be so terrible if the cost of living actually went down 1 year? Is that a disaster if food got cheaper, if energy got cheaper, if education, if healthcare? Wouldn't that be a good thing if all the things we needed to buy were less expensive instead of more expensive? And why are you trying to force a higher rate of inflation on the European people? It made no sense. And in fact, if you go back to the roots of this 2% inflation mandate, it wasn't to get to 2%. 2% was supposed to be the ceiling. If they got to 2%, it was too high. So it was just, hey, stay below 2%. It didn't mean that 1% wasn't enough and you had to get it up to 2%. 1% was fine. 0.5% was better. Just keep it below 2%. Well, the ECB turned the mandate on its head and it turned the ceiling into a target. And why did it do that? It was all a lie from the beginning. The reason that the ECB did quantitative easing, the reason it kept interest rates in negative territory was not because they had to save the Europeans from a cost of living that wasn't rising fast enough. It was all about bailing out reckless European politicians, bailing out the Italians, bailing out the Spanish, bailing out any government that was running a big deficit that didn't want to have to come to terms with the reality of having to cut government spending. And so in order to enable the profligacy of a lot of European countries, they kept creating inflation. They kept doing quantitative easing. And all the while, I was warning that this was going to backfire, that eventually consumer prices would explode well above 2%. And then the ECB would be in a predicament because it would be unable to return inflation to 2% without completely destroying the bubble economy that had been inflated, because now all of these governments would be forced to make even deeper cuts to government spending than the ones that the ECB spared them from making all the years that it was, doing its quantitative easing program. That just because they're printing all this money and you don't see an immediate rise in consumer prices, it doesn't mean that that rise isn't going to eventually happen. And by the time it does, it's too late to put the genie back in the bottle. I mean, the Germans had a horrible experience with hyperinflation during the Weimar Republic. They don't want to relive that experience again with the euro, but there is a threat now that that's exactly what's going to happen. The government acknowledges with the official statistics. But what is ultimately, I think, going to happen is interest rates in the Eurozone are going to have to go much, much higher. And when that happens, there is going to be a turn in the euro. The euro is going to start to rise against the dollar, and that will help mitigate inflation in the Eurozone. It's not going to bring it back down to 2%, but at least a euro that strengthens against the dollar will help. But when the dollar starts to fall against the euro, that's going to push the U.S. inflation rate much higher. And it's not just the euro that the dollar is going to fall against. It's going to be against pretty much all the currencies in the world. And in fact, the euro will probably continue to fall against a lot of the emerging market currencies, even as it rises against the dollar. But I think it's these Western countries that have done all the quantitative easing, that have kept interest rates so low. These are the countries that are going to experience the most inflation and the largest reduction in their standard of living. As far as what happens in Europe, will the Eurozone disintegrate? Will a lot of these countries break away? Will, the euro go away? Will the Deutschmark return? I don't know. I mean, a lot of problems lie in the future. The experiment with the euro was always a flawed. I talked about it from the very beginning 20 years ago.
Yeah,
that
true.
It wasn't going to work because of the moral hazard implicit in the fact that you have so many countries that could run big deficits and push off the cost of financing them on another country. I mean, Germany really got, the raw end of the deal. As much as the Germans thought this was great, we have more markets that we can export our products. That was, the wrong way to look at it. I mean, you don't want to export just so you can export. You export to pay for your imports. You don't export just to give away your products. You want to use the money you earn from exports to pay for your imports. But Germany had a long history of responsible monetary policy, of fiscal prudence, but a lot of the countries in Europe did not. Italy, and Spain, France, a lot of countries there, they had a long history of budget deficits, inflation, depreciating currencies. And a lot of people thought, the euro is going to be like the Deutschmark. It's not. The euro is like the lira or the drachma. That's the problem. They're going to be in trouble. And either they have to deal with the political reality of having to cut government spending dramatically, or they've got to pull out of the Eurozone entirely and go back to their own currencies, which will be an even bigger disaster because then they'll have even more inflation. But, that would be good for Germany. I mean, you can't keep, carrying the weight of these countries and shouldering the burden of financing their deficits and giving their politicians, an easy way out to promise voters something for nothing. So the ECB is going to have to push rates up and just allow the consequences to play out. But of course, the Federal Reserve has to do the same thing over here. I mean, we don't have the threat of states leaving the union, although I think a lot of states would probably like to be able to leave the union, they did prior to the Civil War, although that didn't work out that well for the Confederacy. But we're going to have a lot of problems too, because if the Federal Reserve were to allow interest rates to rise to a level that would be able to return inflation anywhere near 2%, it would cause the same type of problems, because now the U.S. government would be forced to dramatically cut government spending on things like Social Security and Medicare, not in the distant future, but right now. And of course, I think if interest rates were allowed to rise to where the market needs them to be, the U.S. government would really have no choice but to default on its treasury debt. There is no way the U.S. government could pay interest on its debt, just like there's probably no way Italy could pay interest on its debt. If the debt went up, they would have to restructure. The same thing would happen with the United States. We have to deal with the reality of too much debt. The reason we haven't had to deal with it for so long is because the central banks were able to keep interest rates so low. They were able to keep monetizing the debt. And the reason they were able to do that is because they said we didn't have enough inflation. It was only because they can pretend that sub 2% inflation was not enough. That's what allowed them to get away with creating all this inflation. But now that inflation is the problem, they can't get away with it anymore unless they want to acknowledge that high inflation is a permanent way of life. And the minute they make that announcement, well, then you have a run on the whole fiat-based monetary system, because nobody is going to want to hold on to a currency if they know it's going to lose 10 or 20% of its value every year, as far as the eye can see. Everybody's going to reject these currencies and they're going to buy gold, they're going to buy silver, they're going to get into real assets, and they're going to get out of paper. When you talk about a strong dollar, it's only strong in relation to the euro or the yen. In terms of purchasing power here in America, it's very weak because the dollar is losing value every day. Everything gets more and more expensive. So it's only on a foreign exchange basis that the dollar is strong. On a purchasing power basis, it's very weak. But the only reason that the dollar has been strong is the false perception that the Federal Reserve is going to win its fight against inflation. And every time we get a higher than expected inflation rate, the markets just think that that means the Fed's going to have to fight harder to win the fight, and interest rates are going to go higher for longer, and they buy the dollar. But what the markets haven't come to grips with yet is that the Fed is going to lose. Inflation is going to win. In fact, the Fed is going to surrender the fight because it's going to have to turn its attention to what it perceives to be an even bigger problem, which is either heading off a financial crisis or, if it waits too long, trying to bail us out of a financial crisis, just like they just saw in the UK, where the British were hiking rates and all of a sudden they were going to blow up their pension system due to leveraged bond portfolios. And so they had to turn around and go back to quantitative easing. The same thing is going to happen in the United States. We have a much bigger debt bubble than the one that popped in 2008. And if the Fed raises rates, or they have raised rates, it's only a question of time before something blows up. We have more leverage than ever before. The whole economy is propped up based on cheap money, inflation, artificially low interest rates. It's a phony economy. And the minute you take away those artificial supports, everything that you built on top of it has to crash. So we cannot fight inflation without simultaneously destroying the economy that was built on a foundation of inflation. And so when we really start to see the implosion, we're already in a recession. When it gets much worse, when we start to see bigger problems, the Fed is going to shift its attention and not focus on inflation. It's only worried about inflation now because it's a problem for the voters, it's a problem for politicians, so it has to pretend that it's going to do something about it. But if you remember the initial rhetoric coming out of Powell was only really willing to fight inflation when he thought he could do it without hurting the economy. He said we had this super strong economy, red hot labor market, and so because of this economic strength, the Fed had the leeway to raise interest rates and fight inflation because the economy was so strong, it could handle it. But if the economy is in recession or depression and we have a financial crisis, there's no way the Fed is going to turn a blind eye to that and just keep on hiking interest rates to fight inflation. In fact, the politicians won't allow it.
Yeah. So what do you think? When will the Fed pivot? You think it will be this year, next year, or will they go to 5%?
You know, I think the markets are already finally starting to sense that the pivot is coming. Look at the gold market. Gold's had a nice rally from the lows, and it doesn't look like it's going to make a new low. The dollar had a pretty big pullback from its highs. So it's quite possible that the dollar rally is over and the gold sell-off is over. And if that is the case, it means that investors are seeing through the smokescreen, at least a little bit, and recognize that the Fed is all bark and no bite when it comes to its commitment to actually fighting inflation. Yes, they've been able to go this far, but they're not going to go the distance because it would involve too much political pain, economic pain, bankruptcies, foreclosures. Investors would lose a lot of money. A lot of people would lose their jobs. All this is necessary. This is all part of creative destruction. It's all what the free market needs to do to purge the economy of all the mistakes that were made thanks to artificially low interest rates. The government and the central bank screwed up the economy dramatically. And in order to have a real recovery on a solid foundation, the free market needs to purge the economy of these excesses and these mistakes. And it can't be done without people losing money and losing jobs. This is all a necessary part of the process. But from a political perspective, nobody wants that. That's why we did QE for so long. That's why rates were so low for so long, because nobody had the stomach to allow market forces to correct the mistakes. So instead, the mistakes got bigger and bigger and bigger because they they never got corrected. I think this is the beginning of the end of the U.S. dollar-based monetary system, and the dollar's role as the reserve currency is going to come to an end. And I think that is a good thing for the rest of the world. In the short run, it's going to be very bad for the U.S. In the long run, it depends on how we react to it. It could end up being a good thing, or it could end up being a very bad thing. But in the short run, it's going to mean a much lower standard of living for Americans and a much higher standard of living for everybody else, in particular, people who live in the emerging markets that have been financing America's trade deficits, that have been producing all the stuff that we consume and loaning us the money to pay for it. But the way I think it's going to go down is, first of all, the markets are going to anticipate the pivot before the Fed pivots. So the dollar is going to start declining, and I believe that decline has already begun. It will accelerate. The increase in the price of gold has begun, and it will accelerate. But at some point, whether it's the market crashing or some bank blowing up or a hedge fund or maybe some state government, a municipality starting to default, I mean, something bad is going to happen, or it's going to be a big surge in unemployment, maybe a lot of layoffs. I mean, there's going to be some event that is going to precipitate the actual pivot that the markets had anticipated. And then when that finally happens, I don't think it's going to be, like a buy the rumor, sell the fact, where the Fed's going to pivot and then gold's going to sell off and the dollar's going to rally. I think that will just kick the dollar sell-off into a higher gear and fuel the move in gold, because I think there are a lot of people that don't want to preempt that. I think there's a lot of investors that are like waiting for a clear sign that the Fed has pivoted before buying gold, before selling the dollar. I think that's a mistake. I think it's better to have the guts to anticipate the pivot, because you're going to make even more money. You're going to get a better entry. But if you want to wait for an engraved invitation from the Fed before you buy your gold, you could do that. You're just not going to get as good a price as if you were to buy it right now. But I think that's going to happen. Now, the bond market, I think there it's going to be interesting, because I think the knee-jerk reaction to the Fed going back to quantitative easing will be the bond market rallies a bit, but then it's going to get killed. The bonds will get decimated by the Fed's pivot, especially the longer-term 30-year bonds. The only reason the 30-year Treasury only yields about 3.7, 3.8% right now, despite the fact that we've got 8% inflation, is because bond investors are confident that the Fed is going to bring inflation back down to 2% and that it's going to stay there for the next 30 years. That is a laughable assumption to make. Our national debt just hit $31 trillion. It's risen by $1 trillion in the last 8 months, but it's probably going to rise by $1 trillion now in about 5 or 6 months. And soon we're going to be adding $1 trillion a quarter based on the increase in debt. And during the next recession, the debt's going to explode. So we're going to have 40 trillion, 50 trillion worth of debt. And this is actually the tip of a debt iceberg, because we have all sorts of unfunded liabilities that we don't even discuss. So the U.S. government is massively in debt, and it has no hope of repaying the debt. The only way out of it, other than default, is inflate. And so to think that inflation is going to stay 2% for 30 years is crazy. But once the Fed goes back to quantitative easing, even though inflation is still nowhere near 2%, and sends inflation into double digits, the bond market will crash. Then, if the Fed really ramps up quantitative easing to stop the bond market from crashing, then the dollar will implode. But the Fed is going to have to choose one or the other. Does it let bonds crash, or does it save bonds and crash the dollar instead? It's not going to be able to save the dollar and the bond market. But of course, if the dollar crashes, then your bonds aren't worth anything anyway, because all your bonds are promises to pay dollars. So if the dollar crashes, it doesn't matter if the bonds don't, because the value of the bonds is still crashed, because all they are is, receipts of dollars.